Welcome back to the Deep Dive, your go to source for cutting through the noise and getting straight to the insights you need to be truly well informed. Before we dive headfirst, just a quick reminder, make sure you hit that like button and subscribe to the stockanalytics.ai YouTube channel. And hey, for our 4.99 month members, you already know the drill. You get priority deep dives on specific tickers. If there's a company you're itching for us to look at, that's how you get it to the top of our list. Today, we're tackling a real titan of the semiconductor world, Texas Instruments. We're going to pull back the curtain on its multi-billion-dollar bet on U.S. manufacturing. Is this a strategic masterstroke, setting them up for decades of dominance? Or is it maybe a catastrophic gamble in a world increasingly defined by trade wars? We're going to explore exactly what that means for its future and, well, for its stock.
That's right. Our deep dive today is into Texas Instruments Incorporated, ticker symbol TXN. And it's really crucial for you to know that this entire analysis, everything we talk about, it's grounded in financial data and market metrics as of June 18th, 2025. That day, TXN closed at $198.35 a share, just so we're all on the same page.
Okay, so our mission is clear. We're going to unpack TXN's core business, scrutinize its management, and really dissect its financials in part one. Then, in part two, we'll analyze market sentiment, ownership, and the significant risks shaping its future. By the end, you'll have all the nuggets of knowledge to understand the powerful forces at play here. Chapter 1, Business Analysis. All right, let's kick things off by really unpacking what makes Texas Instruments tick, what's their core business, and how do they make that immense revenue?
Okay, so at its heart, Texas Instruments, or TI as most people call it, designs, manufactures, and sells semiconductor chips globally. They're headquartered down in Dallas. It's a colossal operation. Pulled in about $15.64 billion in revenue in fiscal year 2024. Their business is fundamentally split into two main product segments. You've got analog, which is dominant, really dominant, 78% of the revenue, that's $12.16 billion. And then there's embedded processing, making up 16% of revenue, about $2.53 billion.
That huge lean into analog and embedded processing, that was a strategic pivot, wasn't it? They moved away from consumer gadgets like phones and PCs. What was the thinking there?
Exactly. TI deliberately shifted its focus. I mean, they sort of saw the writing on the wall. The personal electronics market can be really volatile, right? Ups and downs. So they pivoted pretty aggressively, actually, towards the much more stable industrial and automotive sectors. In 2023, those two combined for a huge 74% of their revenue. Industrial applications led at 40%, automotive right behind at 34%. And this wasn't sudden. It was a conscious multi-year decision to find more reliable, long life cycle revenue streams.
Right, so their chips aren't just for your everyday phone anymore. What kind of chips are we talking about in these, industrial and automotive spaces?
Well, their product portfolio was vast, really vast. Analog semiconductors, those are the essential bridge between the physical and digital worlds. They manage power, convert real-world signals like temperature, light, sound into digital data, and back again. Think of them maybe controlling power in a factory robot or sensing pressure in a car tire. And TI is, quite impressively, the world's largest producer of these analog chips. Embedded processors, on the other hand, they're like the digital brains for specific tasks. Could be anything from a microcontroller and a smart toothbrush to, complex motor control systems and big industrial machinery. And yeah, their other category even includes their DLP technology, that's digital light processing you see in projectors, plus, of course, those classic calculators.
Wow. So TI isn't just big. They are the undisputed #1 player in the analog semiconductor market globally. Tens of billions of chips annually from 15 manufacturing sites. That's not just scale. It sounds like a strategic moat. Give them cost advantages, supply chain resilience.
It absolutely is.
Yeah.
And that scale, it underpins their entire value proposition. It's built on four core competitive advantages. First, manufacturing and technology. Owning their own factories, their fabs, gives them lower costs and a more dependable supply. Big deal. Second, their broad portfolio. We're talking 80,000 products. They're basically a one-stop shop for many customers. Third, reach of market channels. They've massively increased direct sales. By 2024, 80% of sales were direct, up from just a third back in 2019. That means stronger customer ties, better market feedback, And finally, diversity and longevity. They serve markets with really long product life cycles. Think industrial equipment, cars. That ensures stable, predictable revenue for years.
Okay, that's a strong internal picture. But TI doesn't operate in a vacuum, right? Let's zoom out a bit. How's the broader semiconductor industry doing right now? What are the major tailwinds?
Yeah, the semiconductor industry is definitely on a strong growth path. Projections suggest global sales could hit $697 billion in 2025, maybe even top $1 trillion by 2030. The key drivers are pretty powerful. You've got the huge demand for generative AI, especially those AI accelerator chips going into PCs and smartphones now, plus continued expansion in core markets like advanced automotive tech, more chips per car, and industrial automation.
And competitors, you mentioned the analog and embedded markets are fragmented. So you've got analog devices, NXP, microchip.
Right.
TI's market cap is huge, like $181 billion. How do they stack up? ADI is $111 billion, microchip much smaller at $35 billion.
Exactly. It really highlights TI's scale advantage over its direct competitors in analog and embedded.
Yeah.
Now, companies like NVIDIA, they're in a totally different sphere. High-end GPUs, AI accelerators, not really direct rivals in TI's core markets.
What about regulations, like the CHIPS Act here in the U.S.?
Yeah, the regulatory landscape is a big factor. The U.S. CHIPS and Science Act is definitely bolstering domestic manufacturing, and TI has been a major beneficiary. They were awarded up to $1.6 billion in federal funding for expanding their facilities in Texas and Utah. That's a substantial tailwind for their U.S. investment strategy.
But it's a double-edged sword, you mentioned.
It is. It's counterbalanced by international tariffs and trade restrictions,
Yeah.
which, yeah, we'll definitely delve into as a key risk later on. It's crucial.
So breaking into this industry sounds incredibly difficult. The barriers to entry must be huge.
Oh, they're formidable. Immense. First, just extreme capital intensity. TI itself has a $60 billion investment plan ongoing. Single factory projects can cost tens of billions. Second, you need deep technological expertise. That's non-negotiable. TI spent $2 billion just on R&D in 2024. And third, the sheer economies of scale. You need massive volume to make these kinds of investments pay off. And this is really where TI's strategic focus on 300mm silicon wafers for its in-house manufacturing comes into play. It gives them a structural cost advantage. An unpackaged chip on a 300mm wafer costs about 40% less than one on an older 200mm wafer, which a lot of competitors still rely on. They're aiming for over 90% internal manufacturing by 2030 to really maximize that cost efficiency.
And once a customer picks TI, it's not just about the cost, is it? There's a stickiness factor.
Absolutely. High switching costs.
Yeah.
Especially in embedded processing. Manufacturers invest a ton of time and money in software development that's specific to TI chips. So that creates powerful incentives to just stick with TI for future product generations. It builds incredibly sticky long-term customer relationships. It's a real advantage.
Chapter 2, Management Evaluation. Okay, with that deep understanding of the business, let's pivot now. Let's talk about the leadership steering this Titan. What kind of team is at the helm? Experienced? Stable?
Yeah, Texas Instruments management is definitely characterized by deep industry experience and, well, remarkable longevity. Hervé Villain stepped into the CEO role in April 2023, so he's relatively new in that seat, but Chairman Richard Templeton is a long-standing veteran, a fixture. The average management tenure is about 5.8 years, and the board tenure is even more impressive, 10.8 years. So yeah, that suggests a very stable, very experienced team that knows this industry inside and out.
Their history in handling crises gives us a window into how they operate, right? Like the 2008 financial crisis.
Oh yeah, that's a fascinating case study.
TI cut, what, 3,400 jobs?
Yeah.
Stock fell over 60%.
Right, a staggering 62.4% drop. And management reflected on that period. They realized their customers had overcorrected by slashing orders way too deeply, which kind of created an artificial downturn, worse than it needed to be.
So how did they apply that lesson, like during the COVID pandemic in 2020?
That's what's really insightful. Remembering that pain from '08, that pain of chasing demand after the recovery started, they made a very conscious, very contrarian decision. They kept the factories running. They deliberately built up inventory. They were basically betting on a sharp V-shaped recovery.
Which turned out to be right.
Spot on. The stock only fell about 30% this time, and it bounced back fully in just 3 months. This wasn't just luck. It really shows a long-term kind of through-cycle philosophy that, honestly, few companies manage to execute so effectively.
Okay, what about transparency and ethics? They seem pretty open, right? Investor relations website, corporate citizenship report.
They are quite transparent, yes. But it's worth noting third-party ratings give kind of a mixed picture.
Yeah.
S&P gives them an A+ credit rating, which is excellent, obviously. But on ESG, environmental, social, governance, Sustainalytics, assigns them a medium risk rating, 20.4, which, maybe surprisingly, lags behind peers like AMD and TSMC, who get low-risk ratings.
Huh. Any other flags?
Well, 1792 Exchange gives a high-risk rating, citing yielding to political activism and implementing certain corporate policies. They've also seen some shareholder proposals seeking more reporting on things like human rights and the gender pay gap. So while they are transparent, they definitely face scrutiny in certain areas.
Okay, let's shift gears to how they manage their money. Capital allocation. Especially with those massive investments we talked about earlier. What's the strategy?
Their stated objective is pretty singular: maximize long-term free cash flow per share. That's the North Star. So their primary investment is organic growth. That includes a consistent $2 billion annual R&D budget, and crucially, those massive capital expenditures, CapEx roughly $5 billion per year from 2023 through 2025 to build their new 300 millimeter fabs in the U.S.
Right, that aggressive CapEx plan. That caused some waves, didn't it? I remember Elliott Investment Management got involved.
Indeed it did. In May 2024, Elliott argued that this huge CapEx push actually deviated from that core goal of FCF growth per share and said it led to underperformance. They proposed something called a dynamic capacity management strategy, aiming for over $9 in FCF per share by 2026. So it really highlights that tension between long-term strategic investment and, short-term financial metrics.
What about acquisitions? M&A.
Their M&A strategy seems pretty opportunistic. They tend to acquire distressed assets, like that 300 millimeter fab in Lehigh, Utah they bought from Micron. Got it for a fraction of what it would cost to build new. Smart move, potentially.
And returning cash to shareholders, that seems like a big priority for them.
Oh, absolutely non-negotiable. They commit to returning all remaining free cash flow, whatever's left after investments, through dividends and share repurchases. Their dividend track record is stellar. 21 consecutive years of increases. That's a powerful signal of financial strength. Current yield is around 2.74%, and they target a payout ratio of 40–80% of FCF.
And buybacks.
Aggressive there, too. They've reduced shares outstanding by 47% since 2004. That's huge. And they still have $20.3 billion remaining authorization.
Okay, so given these enormous investments, what does that do to their return on invested capital? ROIC, that must be taking a hit.
You got it. Historically, TI has been an elite performer on ROIC, consistently in the 88th percentile of S&P 500 companies, really top tier. However, yes, this massive CapEx cycle will cause ROIC to decline in the short term.
Right.
No way around it. The denominator, invested capital, is just increasing dramatically, billions and billions. While the numerator, net operating profit after tax, has been under pressure from the market downturn. But, and this is key, this expected decline is a direct and predictable consequence of management's long-term strategy. It's a strategic sacrifice for future gain, not, a sign that business is broken.
Chapter 3, Financial Analysis. All right, let's dig into the financial numbers that really tell the story, starting with their sheer size, market cap.
As of that June 18, 2025 date, Texas Instruments had a market capitalization of approximately $181.13 billion. Puts it firmly in the large cap category. Very large.
And looking at revenue growth over the last 5 years, it looks like a classic semiconductor cycle story.
It really is. Textbook example. After strong growth in 2021, up almost 27%, in 2022, up over 9%, revenue definitely declined in 2023, down 12.5%, and again in 2024, down almost 11%. Directly due to those broader market downturns. A clear ride on the industry roller coaster, as you said.
Profit margins, too. Historically high, but feeling the pressure.
Exactly. Feeling the pressure from both the cyclical downturn and the intense costs of expanding capacity. Gross margin peaked at a really impressive 68.8% in 2022, but by 2024 it had fallen back to 58.1%. Similarly, operating margin hit an incredible 50.1% in 2022, but dropped to 34.9% in 2024. Now, these are still strong margins, don't get me wrong, but the compression is definitely evident.
Okay, free cash flow, FCF generation. This is the critical metric right now, isn't it? Especially with those CapEx plans. What's the story there?
Yeah, FCF has seen a dramatic decline from over $6.3 billion back in 2021 down to just $1.69 billion in 2024. Big drop. But here's the crucial nuance, the important distinction. This isn't because their core operations collapsed. Cash from operations actually remained quite robust, $6.3 billion in 2024. Pretty stable.
So it's all the CapEx.
Exactly. It's a direct consequence of soaring CapEx, which hit $4.8 billion in 2024. This is that conscious financial trade-off they're making, investing heavily today for hopefully much higher FCF tomorrow. That's the bet.
So even with these huge investments, how stable are they financially? I mean, are they stretching themselves too thin?
Well, their earnings consistency over 10 years actually shows an upward trend despite the cycles. EPS peaked at $9.41 in 2022, before declining to $5 in 2024. But the long-term trajectory has been impressive. Their debt-to-equity ratio was 0.78 or 78% in Q1 2025. That's a moderate, generally seen as manageable level of leverage. It has trended upwards, yes, to finance that capex, but it seems well within comfortable limits for a company this size.
And liquidity, how much cash cushion do they have?
Exceptional liquidity. Their current ratio was 4.1 times at the end of fiscal year 2024. It even improved to 5.26 times in Q1 2025. That provides a really significant financial cushion against market volatility or unexpected bumps.
And the dividend, still solid.
Rock solid. As we mentioned, 21 consecutive years of increases, impressive 5-year and 10-year growth rates, compound annual growth rates of 9.76% and 15.31% respectively. That really speaks volumes about their financial discipline and commitment to shareholders, a cornerstone for income investors for sure.
Okay, so given all these dynamics, the strategy, the cycle, the investment, how is TI valued by the market right now? Is it trading cheap, or are investors already pricing in that big long-term strategic bet?
Well, their price to earnings or PE ratio stood at 37.28 as of June 18, 2025. That's based on the $198.35 stock price and trailing 12 months EPS of $5.32. Now, that 37.28 PE is significantly high. It's more than 60% above its own 10-year historical average, which is around 23.12.
Wow, 60% above average, so the market's optimistic.
Extremely optimistic, yes. That tells us the market is paying a hefty premium right now, essentially pricing in significant future earnings growth and success from that big strategy. Compared to peers, it's interesting. It trades at a discount to analog devices, which had a PE over 61, but at a premium to NXP semiconductors, around 23.
Okay, what about intrinsic valuation? We often use a discounted cash flow or DCF model. How does that view TI's value?
Right, the idea that a business's value is the sum of its future cash flows discounted back to today. An independent DCF model we looked at estimates an intrinsic value range of about $120 to $140 per share for Texas Instruments. And that range seems pretty consistent with other third-party analyses out there.
And what are the key assumptions driving that $120, $140 range?
The key inputs are, well, first, the growth rate assumptions. It uses a multi-stage approach. Stage 1, the first 1 to 5 years, assumes 7-9% growth. That reflects the expected recovery and the ramp-up of those new fabs. Stage 2, year 6-10, assumes a more mature 4-6% growth rate, as the industry perhaps slows a bit. And then beyond 10 years, a perpetual growth rate of 2.5%, basically aligned with long-term GDP growth.
And the discount rate? How much are those future cash flows being discounted?
The discount rate, or WACC weighted average cost of capital used in the model, is approximately 9.1%. That blends the cost of equity, which is calculated using things like the risk-free rate, around 4.41% from the 10-year Treasury, TI's beta, around 1.18, and an equity risk premium, 4.5%. And it blends that with the after-tax cost of debt, which is lower, around 3.5%. So that 9.1% is basically the minimum return TI needs to generate to make its investments worthwhile for all its capital providers.
Chapter 4, Market Sentiment. All right, part 2. Let's turn our attention now to what Wall Street is saying about TI. What's the vibe? And what kind of buzz is circulating in the media? Is it all positive, or is there some skepticism floating around?
It's definitely not all sunshine, no. Looking at analyst price targets, the consensus rating is generally hold, or maybe moderate buy. But what's really striking, quite interesting actually, is that the average 12-month price target from analysts somewhere in the $183 to $190 range is significantly below the actual trading price of $198.35.
Huh. So analysts are more cautious than the market itself.
That's what it suggests. Yeah, the market seems to be pricing in a far more optimistic scenario than the average analyst is forecasting, perhaps looking well past those near-term risks we've discussed.
And the media narrative seems kind of split.
It's sharply divided, I'd say. You see plenty of positive coverage, especially hailing that massive $60 billion U.S. manufacturing investment. It's framed as strategic, long-term, even patriotic sometimes. But then you see significant negative coverage, particularly focusing on those geopolitical risks. Lots of headlines about U.S.-China trade tensions, retaliatory tariffs, and how they could directly impact TI. So the overall sentiment feels like a complex mix. Admiration for the long-term vision, but real anxiety about these immediate global trade disputes.
What about market indicators, like short interest? Are people betting against the stock?
Not really, no.
Yeah.
Short interest is quite low, hovering between, say, 1.96% and 2.13% of the public float. That indicates there isn't a large, coordinated bet building up that expects a significant price decline. Often suggests some underlying confidence, or at least not strong conviction on the short side.
And technically speaking, price versus moving averages.
Technically, the picture looks strong right now.
Yeah.
The stock price, that $198.35, is trading significantly above both its 50-day moving average, which is down around $174, and its 200-day moving average, which is around $182, $189. So from a technical perspective, that signals strong short-term momentum and confirms a longer-term uptrend is currently in place.
Chapter 5, ownership structure. Okay, let's look at who actually owns Texas Instruments. Is it concentrated in a few hands or more widely spread?
It's overwhelmingly owned by large financial institutions. Institutional ownership is very high, somewhere between 85% and 90%. It's dominated by the usual big asset managers. Vanguard holds about 10.35%. BlackRock has 9.22%. State Street with 4.65%. It's pretty typical for a large cap company like TI, largely passive index-driven ownership.
What about insiders? The executives, the board members themselves, are they buying stock, selling stock? What's the trend?
Well, first off, insider holdings are remarkably low. Just about 0.2% to 0.6% of the total outstanding shares are held by insiders.
Really low.
Yeah. And maybe more significantly, looking at recent insider transactions, there's a very stark trend. There have been numerous sales, somewhere between 42 and 47 separate sale transactions by insiders over the last 6 to 12 months. And crucially, virtually no open market purchases by executives during that time.
No buying at all. Who's been selling?
Chairman Richard Templeton, the veteran we mentioned, has been a particularly active seller. Now, you have to be careful interpreting insider sales. There can be many reasons. But the complete lack of buying could suggest that insiders, the people who know the company best, don't necessarily see the stock as significantly undervalued at its current price.
Makes sense. And overall ownership concentration. Is any one institution calling the shots?
Not really, no. Ownership isn't highly concentrated. The top 10 institutional shareholders combined own about 38% of the company. Again, pretty typical for a large cap company like this. It means no single outside investor holds controlling influence.
Chapter 6, risk assessment. All right, let's pull things together with a SWOT analysis. Identify those internal strengths and weaknesses and the external opportunities and threats facing TI. First up, strengths. What are their undisputed advantages?
Okay, core strengths. Number one, definitely market dominance. They're the undisputed leader in analog semiconductors. Two, their immense manufacturing scale and that cost advantage from the 300-millimeter wafer strategy. That's huge. Three, that broad product portfolio creating high switching costs for their customers, stickiness. And four, a fortress balance sheet. Really strong liquidity gives them flexibility. These all contribute to a very wide economic moat.
Okay, now, weaknesses. What internal limitations or vulnerabilities do they have?
Well, the flip side of that manufacturing scale is high capital intensity. As we discussed, that leads to periods of depressed free cash flow during heavy investment cycles. They also have significant cyclical market exposure, being so tied now to the industrial and automotive sectors. Those can swing. And related to that, potential margin pressure during downturns because of the high fixed costs associated with running those big expensive fabs.
Right. What about opportunities for future growth? Where could TI really win?
They seem incredibly well positioned for several major long-term growth trends. Think about automotive electrification and automation. More and more chips needed per vehicle. TI is right there. Industrial automation and electrification, the whole smart factory concept. Again, huge demand for their kinds of chips. And the massive proliferation of artificial intelligence. Even if they don't make the core AI chips, AI applications demand ever more sophisticated power management and sensors, which is TI's bread and butter. If that big U.S. manufacturing bet truly pays off as planned, it could lead to significant market share gains across all these growing sectors.
Okay, and finally, threats. What external challenges are lurking out there?
Well, there's always intense competition, sometimes from state-subsidized companies which can distort markets. There's the inherent cyclicality of the semiconductor industry itself, something they manage but can't escape entirely. Constant cybersecurity risks, a threat for any major tech company. And TI is also highly sensitive to broader macroeconomic conditions. High inflation can hurt their customers' purchasing power. Rising interest rates increase TI's own financing costs for all that investment. And of course, a significant economic slowdown would almost certainly lead to a sharp contraction in demand for their products.
But it feels like the single biggest, most immediate threat is geopolitical, right? This is where that massive U.S. manufacturing bet gets really complicated, potentially dangerous.
It absolutely does. This is probably the biggest cloud hanging over them right now. TI has significant China exposure, pulls in, 19 to 20% of its total revenue from customers headquartered there, almost a fifth of the business. Now, here's the critical twist. In April 2025, China didn't just raise tariffs on U.S. goods broadly. That happens. They crucially clarified a rule change specifically for semiconductors. A chip's country of origin, for tariff purposes, is now determined by where the wafer fabrication happens, not just where the final packaging and testing occurs.
Wow. That sounds targeted. Like
Yeah.
it was designed to hit specific companies.
Precisely. It feels like a surgical move.
Hmm.
It's designed to punish companies like TI that are investing heavily in manufacturing their actual silicon wafers in the U.S., while at the same time largely sparing U.S. fabless companies, those that design chips but outsource the actual wafer manufacturing, often to foundries in Taiwan.
So it hits TI directly because of their U.S. investment strategy.
Exactly. It creates this profound strategic paradox for Texas Instruments. Their multi-billion-dollar investment in U.S.-based manufacturing was, in large part, intended to de-risk its supply chain from potential Asian disruptions, secure domestic production, align with U.S. policy like the GTS Act. But in this fascinating, maybe ironic twist of geopolitical fate, this very strategy has inadvertently made TI a prime target for these new, precisely aimed Chinese tariffs. The effort to de-risk the supply chain has, in effect, re-risked a fifth of the company's entire revenue stream. It's a major headache.
Chapter 7. Conclusion. Okay,
Right.
wow. So what does this all mean for Texas Instruments? Let's try to bring together the bull and the bear arguments, get the big picture.
Right, let's synthesize. The bull case is fundamentally a bet on a long-term, meticulously planned, and, they hope, well-executed strategy by what is widely considered a best-in-class operator. Bulls will point to TI's dominant market position, that wide economic moat from manufacturing scale and high switching costs. They'll highlight the proven management team that clearly learns from past cycles. And they see that massive U.S. manufacturing investment not as a cash drain, but as a clear strategic vision for immense future free cash flow growth. Plus, you have those consistent shareholder-friendly policies, the growing dividend, the aggressive buybacks. That's always attractive. So for bulls, the current depressed free cash flow, that's just a temporary but necessary investment phase, planting seeds for future harvest.
Okay, that's the bull case. But the bear case paints a very different picture, doesn't it? It seems rooted in significant near-term risks and, well, that high valuation.
Exactly. The bear case focuses on several key concerns. One, that high PE ratio we talked about, 37.28 compared to its 10-year average of 23.1, suggests it might be overvalued. Two, the near-term free cash flow destruction due to that heavy capex. Bears would argue there's no absolute guarantee of future returns justifying that level of current spending. It's a big bet. Three, and this is probably the biggest one, the extreme geopolitical risk. Having 20% of your revenue stream directly threatened by targeted Chinese tariffs is a serious vulnerability.
And the insider selling adds to that caution.
It does. That perceived lack of insider confidence, shown by the consistent selling and virtual absence of any buying, fuels the bear narrative. Why aren't the people who know best buying at these prices?
So bring it back to valuation. You mentioned the DCF model earlier.
Right. Our educational DCF model, consistent with other third-party analyses, estimates an intrinsic value for Texas Instruments somewhere in the range of $120 to $140 per share.
Okay, and just to remind everyone, as of June 18th, 2025, the market price of TXN stock was $198.35 per share. That's significantly above that $100 to $140 intrinsic value range.
It is a very significant divergence. And what this suggests is that the market is currently pricing the stock with a great deal of optimism. It seems to be largely looking past the near-term cyclical challenges and, perhaps more importantly, significantly under-discounting those severe geopolitical tariff risks. So the investment decision here really hinges on a fundamental disagreement between where the market price is today and a more conservative estimate of intrinsic value. Investing at this level requires a very strong belief in near-flawless execution of what is undoubtedly an ambitious, expensive, and now geopolitically risky long-term plan.
Definitely a lot to weigh there. And as we wrap up, I'm left with this kind of provocative thought for you, our listener, to ponder. What are the long-term implications, not just for PI, but for global supply chains and competitive strategy everywhere, if major companies are increasingly forced to choose between geopolitical alignment, like investing in the U.S., and accessing key revenue markets, like China? How might other industries have to adapt to these kinds of re-risking scenarios? Something to think about. Well, that was our deep dive into Texas Instruments, uncovering the complex strategic bets and, frankly, the significant challenges ahead for the semiconductor giant. Don't forget to like this video and subscribe to the StockAnalytics.ai YouTube channel for more deep dives just like this one. And members, you know the drill. Had your stock suggestions for future videos right there in the comment section. We do look at them.
And just a final reminder, This analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.